Welcome to the Deep Dive. Today, we're tackling something you almost certainly interact with, maybe even daily. A global phenomenon built around, well, a simple cup of coffee.
Or maybe not so simple these days.
True. We are, of course, talking about Starbucks, but we're not just discussing your favorite order.
Nope. Today, we're going deep. We're diving into a really detailed investment analysis of Starbucks Corporation, that's SBUX, on the stock market.
Think of this as your shortcut, your way to get truly informed about one of the planet's most recognizable brands, moving way beyond just, the taste of the coffee to what's actually driving the business.
Exactly. Our mission here is to sift through all the financial jargon, all the dense data in this report we've been studying, and pull out the stuff that really matters.
We want to give you those aha moments, maybe some surprising facts you didn't know.
Yeah, we'll look at where Starbucks is right now, the big hurdles they're facing, what their game plan is, and, what it all means for their future path.
And specifically, we want to unpack why this analysis concludes Starbucks is at a, quote, strategic inflection point. Sounds pretty serious.
It is. It's a critical moment. And just to be clear, all the insights we're sharing, they come straight from this comprehensive investment analysis framework. It's packed with operational data, financial deep dives, strategic insights.
So this isn't just us guessing. It's grounded in some serious research and data.
Absolutely. Solid stuff.
Okay, let's zoom out then. What's the big picture here? Is Starbucks just having a bit of a rough patch, or is this something, more fundamental brewing? Let's start there. Is Starbucks brewing a comeback, or is the coffee still a bit bitter?
That really is the million-dollar question, isn't it? The core argument, the investment thesis from this analysis, it's pretty straightforward on the surface. Starbucks is still the undisputed global leader in specialty coffee, roasting, marketing, selling. They're the benchmark.
Right, undeniable leader.
But they are navigating some pretty significant near-term headwinds right now. And we're not talking minor turbulence. This is more like flying through a proper storm system.
Headwinds, okay, because from the outside, like you said, they seem to be everywhere. Nonstop expansion, lines out the door sometimes. What are these specific challenges making this such a pivotal inflection point kind of moment?
It's that ubiquity that's partly their strength, for sure. But the report highlights a few key issues that are creating real drag. First, there are genuine operational inefficiencies creeping into their stores.
Like what? Longer waits.
Yeah, exactly. Long wait times, maybe order accuracy isn't always spot on.
Yeah.
Things that frustrate customers. Second, you've got these persistent macroeconomic pressures. Inflation, economic uncertainty. It makes people think twice about discretionary spending, like a daily $5 latte.
Makes sense. People cutting back.
And third, and this one might be the biggest deal, the competitive landscape is heating up incredibly fast. It's like a multi-front war for your coffee money. And Starbucks is getting challenged from, pretty much every direction.
Okay, so real immediate pressures, operational hiccups, economic squeeze, intense competition. But you also mentioned foundational strengths. What keeps them so powerful despite all this? What's their secret weapon in this coffee war?
That's where their economic moat comes in. It's deep and wide, built over decades. Despite these current pressures, these core strengths are incredibly tough for anyone else to copy.
Okay, like what specifically?
Well, number one, unparalleled brand equity. Everyone knows Starbucks. It carries a certain image, a certain status still. Number two, immense global scale. We're talking tens of thousands of stores. That creates huge visibility, convenience. It's a massive physical presence.
Hard to compete with that footprint.
Very hard. And third, a deeply integrated digital ecosystem. Their mobile app, the rewards program, it's incredibly sophisticated and creates this powerful network effect. It makes it really sticky for millions and millions of customers. They're locked in.
Right. The app is pretty slick.
Yeah.
So how are they planning to use those strengths to fight back against these headwinds? What's the actual plan?
Okay, so that brings us to the big strategic initiative, the Back to Starbucks turnaround plan. This whole thing is being led by their relatively new CEO, Brian Niccol, who came on board in late 2024.
Niccol, he came from Chipotle, right? Pulled off a big turnaround there.
Exactly. And his track record is a big reason the analysis sees this plan as credible. It's seen as a plausible, though definitely challenging way for them to reignite growth and get profitability back on track.
Challenging, though.
Oh, absolutely. The report is clear.
Yeah.
For long-term investors who can stomach some volatility in the near term, Starbucks could offer a compelling opportunity to create value. But it is highly contingent on disciplined execution.
Execution, that's the key word, isn't it? You can have the best plan in the world.
But if you can't make it happen consistently across 41,000 stores, doesn't mean much. It has to work on the ground, barista by barista, store by store.
Okay, so let's dig into the key findings that really highlight why this is such a critical inflection point. What are the core problems that made this big turnaround plan absolutely necessary?
Well, the first major finding the report digs into is pretty stark. Significant operational strain and noticeable financial deterioration. If you look closely at their recent numbers, say from fiscal 24 through the first 3 quarters of 25, it paints a picture of a business really feeling the pressure.
Not just a minor dip then.
No, not at all. It looks more systemic.
And for a retailer like Starbucks, what's the canary in the coal mine? What's the single most alarming signal of that kind of stress?
It's got to be the declining global comparables store sales, comps as they call them. That metric tells you how stores open for at least a year are doing, so it strips out the effect of just opening new locations.
And those are down?
They are. And it's being driven, worryingly, by negative transaction growth. Fewer people coming through the door, especially in the super important U.S. market.
Ouch. Can you give us some numbers on that?
Yeah, for example, in Q3 of fiscal 25, global comps dropped 2%. U.S. comps also fell 2%. But here's the kicker. U.S. transactions, the actual number of customer visits, down 4%. That's after being down even more before that.
So fewer people are visiting. That's fundamental.
It is. And this weakness at the top line, combined with the money they have to spend strategic investment in labor to improve service, plus more promotions to try and lure people back, it's led to what the report calls severe operating margin compression.
Meaning less profit on each sale.
Exactly. For every dollar of coffee they sell, significantly less is dropping to the bottom line compared to historically. It's a big departure from the kind of best-in-class profitability they used to boast about. A real hit.
Wow. Okay. Tough spot. So how does Nichols' Back to Starbucks plan directly attack that specific problem, that decline in traffic and profit?
Well, his appointment in late 2024 really marked the kickoff of this ambitious company-wide effort. The plan basically has 3 main pillars. First, they're doubling down on operational speed and efficiency. They call it winning the peak, focusing on those super busy morning hours.
Getting drinks out faster, basically.
All right. Second, they're actively reinvesting in the in-store experience, trying to recapture that third-place magic, making the cafes places people actually want to hang out in again.
Bring back the comfy chairs.
Maybe.
And third, they're pushing product innovation. New drinks, new food to keep things fresh and give people new reasons to come in.
Sounds logical, but you said it carries execution risk.
Huge execution risk.
Yeah.
And it's expensive. These investments, especially in labor and store upgrades, aren't cheap. They will continue to squeeze margins and free cash flow in the short term. It's like they have to spend money now to hopefully make more money later. It's a gamble, but probably a necessary one.
It really does sound like they're caught in a pincer movement in the market. Can you elaborate on that competitive landscape? Who's putting the pressure on?
Absolutely. Their economic moat, which used to seem impenetrable, is facing its toughest test in, well, probably decades. It really is a multi-front battle. On one side, you have the big, value-focused QSR players. Think McDonald's with McCafe, think Dunkin'.
Cheaper, faster alternatives? Exactly. They compete hard on price and convenience. They make Starbucks look potentially expensive or slow by comparison, especially for someone just needing a quick caffeine fix.
So attack from below on price. But you mentioned another angle.
Yeah, the other side is arguably just as challenging. It's the rise of more agile, experience-focused players. Think about fast-growing chains like Dutch Bros, which is a real cult following, especially with younger crowds.
Right, known for customization and that energetic vibe.
Totally. Or think about the huge, fragmented market of independent coffee shops. They compete on authenticity, artisanal quality, unique atmosphere. They're taking share, especially for those longer visits where people want an experience, not just a transaction. They are directly challenging that third-place idea that Starbucks pioneered.
So squeezed from below on price, squeezed from above on experience. That's tough.
It really is. And it means Starbucks' pricing power, their ability to charge a premium, is being tested like never before. It's forcing this costly internal reset just to get customers back in the door consistently.
Okay. Given all this turmoil, the operational issues, the competition, the turnaround costs, how is the stock market actually valuing Starbucks right now? Does the price reflect these challenges, or is there still a lot of optimism baked in?
That's a key part of the analysis.
Yeah.
The stock, SBUX, it actually trades at a premium compared to many of its QSR peers.
Still, even with the recent problems.
Yes. And that premium suggests the market is, to a degree, optimistic. It seems to be betting that this turnaround plan under Nichols' leadership will work.
So the valuation is pricing in success already.
Essentially, yes. The analysis suggests the current valuation reflects expectations of a reasonably successful, though not flawless, execution of the back-to-Starbucks strategy.
Which makes the stock
Highly sensitive to actual results. If those key operational metrics, like transaction growth, don't start showing tangible improvement soon, the stock could be vulnerable to a significant de-rating. The market is basically saying, okay, we believe you might fix this, so we'll pay a premium for now, but you got to show us the results.
It's a show me story.
Exactly. A classic show-me stock right now.
So after weighing all the strengths, weaknesses, the plan, the risks, what's the final official recommendation from this detailed analysis? Is it a buy, sell, or hold?
The official recommendation is a hold, but with a constructive long-term outlook.
Hold. Okay, explain that.
It means the analysis concludes that the current stock price pretty fairly balances the significant risks involved in the turnaround against the potential rewards if they do execute successfully. It's kind of sitting on the fence waiting for more proof.
And the caution is?
The caution stems from the lack of clear, tangible evidence yet that the recovery is taking hold in the key financial metrics, particularly U.S. transaction growth and stabilization of those operating margins. Until those numbers definitively turn positive and stay positive, the advice is basically to watch closely over the next few quarters for that clear inflection point before committing new money. It's a wait-and-see approach, really. They need to prove it.
Makes total sense. Okay, we've got the overview, the big thesis. Now let's peel back the onion a bit more. Let's get into the nuts and bolts, the business and operational profile of this coffee giant. How does Starbucks actually make its money? What does this global empire look like from the inside?
Right, so Starbucks, founded way back in 1985, has built this global empire on a really multifaceted business model. It's way more complex than just the cafes you see. Their revenue streams are broken down into three main segments, and each one plays a pretty distinct role.
Okay, segment one.
The biggest beast by far is North America. This covers the U.S. and Canada. It's their largest, most mature market, and it accounted for roughly 75%, three-quarters, of their total net revenues in fiscal 2024.
Wow, 75%. So the health of the whole company really hinges on the U.S. and Canada.
Absolutely. The performance here dictates their overall financial health, their ability to fund growth elsewhere, pay dividends, buy back stock, everything. If North America struggles, the whole company feels it immediately. It's the engine room.
Okay, so North America is the core. Where's the future growth supposed to come from?
That's primarily the international segment. This is everything outside North America, and it's seen as the main long-term growth driver. China is absolute pivotal here. It's their second largest market globally.
And China's structured differently, right? They own the stores there.
Correct. All stores in China are company-operated, not licensed. This gives them maximum control over the brand experience and operations, which is crucial in such a strategically vital and, frankly, complex market. It ensures consistency as they navigate that future growth path.
Makes sense. So North America, international. What's the third leg of the stool? What about all the Starbucks stuff you see outside their cafes, like in the grocery store?
Good question. That falls under channel development. This is actually a really interesting high-margin and capital-light part of the business.
Capital light.
Yeah, meaning they don't have to invest heavily in physical stores for this segment. It focuses on selling packaged coffee, tea, those ready-to-drink frappuccinos you see everywhere. Basically anything sold outside their own retail stores.
And how do they manage that?
The cornerstone is a massive long-term deal called the Global Coffee Alliance with Nestlé. Nestlé basically handles the marketing and distribution of Starbucks branded products in grocery stores, food service channels, globally.
So Starbucks provides the brand and the coffee expertise. Nestlé handles the rest.
Pretty much. It provides Starbucks with a steady, very profitable revenue stream with minimal capital investment from their side. It's almost like having a separate consumer packaged goods business tucked inside the company. A really smart, lucrative arrangement.
Okay, so this mix of owned stores, licensed stores, and this channel business, how does the ownership split look globally? Is it mostly company-owned or licensed?
It's actually a pretty balanced hybrid model, and that's by design. As of Q3 fiscal 25, it was about 53% company-operated stores globally and 47% licensed stores.
Almost half and half. What's the strategic thinking there?
It gives them the best of both worlds, really. Direct control is crucial in strategic markets like the U.S. and China, where they need to tightly manage the brand, operations, and innovation. But the licensing model allows for much faster, more capital-efficient expansion in other parts of the world. They can leverage the local market knowledge and capital of their partners.
So they can grow faster without putting up all the money themselves everywhere.
Exactly. It balances control with speed and capital efficiency, allows for quicker market penetration, and lets local partners adapt the model slightly for their specific markets. It's a sophisticated approach.
Speaking of expansion, that global footprint is just staggering. What are the latest numbers on store count and reach?
The scale is truly mind-boggling, unmatched in the specialty coffee world. As of late June 2025, Starbucks had 41,097 stores operating across 87 markets globally.
Over 41,000 stores. Just think about that physical presence.
It's immense. It creates incredible brand visibility. They're almost unavoidable in many cities, and it acts as a massive barrier to entry. You can't just replicate that kind of network overnight. It takes decades and billions.
Is that footprint evenly distributed, or are there heavy concentrations?
It's definitely concentrated. As we touched on, the two giants are the U.S. with 17,230 stores and China with 7,828 stores. Do the math, that's over 25,000 stores, or roughly 61% of their entire global portfolio, just in those two countries.
Wow. So the company's fate is really tied to the U.S. and China, isn't it?
Absolutely. Their overall performance is incredibly sensitive to the economic conditions, consumer tastes, and competitive fights happening specifically within those two nations. It's like a twin-engine jet. Both need to be running smoothly for optimal performance.
And within those markets, the stores themselves aren't all identical, right? I feel like I see different kinds of Starbucks locations.
You're right. They have a diverse portfolio of store formats, and it's constantly evolving. You've got the classic cafe, the traditional third place designed for lingering, working, socializing. That's the original concept.
The comfy chair place.
Right. Then you have the super efficient drive-throughs, catering purely to speed and convenience, especially for commuters. These are often highly profitable. And increasingly, you're seeing smaller footprint concepts like pickup-only stores, maybe even some delivery-focused hubs, especially in dense urban areas where real estate is expensive and digital orders dominate.
And the turnaround plan addresses this mix.
Yes. A key part of the Back to Starbucks strategy is this dual focus. They need to reinvest in enhancing the experience in the traditional cafes to bring back that third-place feel, while simultaneously expanding the convenient formats like drive-thrus and pickup stores to meet the demand for speed and efficiency. It's trying to cater to both needs.
Okay, that makes sense. Now, let's shift to the vital signs, the key performance indicators or KPIs. What are these numbers telling us about the recent downturn that necessitated this whole turnaround effort?
Yeah, the KPIs really paint the picture of why the alarm bell started ringing. The most crucial metric for any retailer, as we mentioned, is comparable store sales comps. It measures growth at existing stores, and after years of pretty steady positive growth,
They turn negative.
they turn negative globally. That's a huge red flag. It signals something's not clicking with the core customer base or the current offering.
Can you give us the specific numbers again on that decline? It sounds pretty severe.
It was. Global comps were down 2% in Q3 fiscal 25. That followed a 1% decline in Q2 25 and a really sharp drop of 7% in Q4 fiscal 24. The U.S. market, again the core engine, saw comps fall 2% in that latest quarter, Q3 25. This negative trend is right at the heart of why the turnaround plan is so critical.
You mentioned digging deeper into how those sales are happening, right? The difference between ticket and transactions.
Yes, and this is where it gets even more concerning. When you break down the comp sales number, you look at two things. Average ticket, how much each customer spends per visit, and transactions, how many customers are actually visiting.
Okay.
The average ticket has actually been going up modestly. But, and this is crucial, that's mostly because Starbucks has been raising prices to offset inflation in their own costs.
So they're charging more, but...
But the number of transactions, the actual foot traffic, has been persistently negative. People are visiting less often.
That's the real problem.
That's the core issue. U.S. transactions were down 4% in Q3 25, and they were down a worrying 10% back in Q4 24. This clearly signals a loss of customer visits or reduced frequency. Even if people spend a bit more when they do come, the fact that they're coming less often is a fundamental threat to a business built on daily rituals.
It suggests people are either going to competitors, making coffee at home, or just cutting back.
All of the above, most likely. It's a clear sign the value proposition isn't resonating as strongly as it used to, or that convenience alone isn't enough.
Despite these traffic issues, are they still opening new stores? Or has that ground to a halt?
They are still opening stores, yes. They added a net 308 new stores globally in Q3 25. But the strategy behind store growth has definitely shifted. It's no longer about just chasing raw unit growth numbers.
What's the focus now?
The emphasis now is much more on the profitability and strategic fit of new locations. They're favoring smaller, more capital-efficient formats, especially in mature markets like the U.S. It's about smart growth, finding the right spots, often filling in gaps in existing markets rather than just planting flags everywhere. Quality over quantity, you could say.
Now, one of Starbucks' biggest assets has always been that digital ecosystem, the rewards program, and the mobile app. It's often cited as best in class. How's that holding up amidst these operational struggles? Shouldn't that be helping to keep people loyal?
You'd think so, and it is still a massive strength. The Starbucks Rewards program is incredibly powerful for driving repeat visits and engagement. At the end of fiscal 24, they had 33.8 million active members in the U.S. over a 90-day period. That's up 4% year over year.
34 million active members in the U.S. alone. That's huge.
It's enormous. And that base gives them incredibly valuable data for personalized marketing, offers, you name it. It creates this virtuous cycle. The more you use it, the more tailored it becomes, the more likely you are to keep using it. It's their direct pipeline to their most valuable customers.
And the mobile app for ordering ahead, paying, it really set the standard, didn't it?
Absolutely. The mobile order and pay system is critical. It boosts convenience, cuts down wait times when it works smoothly, and significantly increases how many people they can serve during those peak rushes. And they know how important it is. Management has flagged that a brand new app and a refreshed rewards program are key parts of their innovation pipeline, scheduled for 2026.
Okay, but here's the puzzle, the paradox, really. If they have this massive growing loyalty program and this super convenient app, why are the actual transaction numbers still falling? It feels like those things should be preventing that.
This is the critical paradox, and it really underscores the depth of the challenge they face. The fact that overall traffic is declining, even with this huge engaged digital base, suggests that the app and the points alone aren't enough anymore.
Meaning
It's likely not enough to overcome perceived weaknesses in the core offering. Maybe it's still the wait times in store. Maybe the atmosphere isn't what it used to be. Maybe people just feel it's not good value for money compared to alternatives, even with the rewards.
So the digital polish can't hide underlying issues.
Exactly. Digital convenience can only compensate so much. That 2026 digital refresh, it's not just about adding new features. It's a crucial defensive move to try and re-engage those loyal customers who might be drifting away, and an offensive move to make the digital experience even more compelling. But it has to be paired with fixing the fundamentals in the stores. Technology needs to support a great core experience, not replace it.
Got it. It's the whole package. Okay, one last piece on operations. There's supply chain and sourcing. How does a company this huge maintain quality and that specific Starbucks taste consistently around the world? What about the ethical sourcing aspect they promote?
Their supply chain is a really sophisticated, globally integrated operation. They have significant control over the key stages, from sourcing the raw green coffee beans to roasting them in their own network of 5 global facilities and then managing distribution.
Vertical integration.
Pretty much for the core coffee component. This gives them immense control over the quality and to some extent the cost of their most critical ingredient. But the flip side is it also exposes them directly to the volatility of coffee commodity prices. When bean prices spike, it hits their bottom line directly, although they do use hedging.
Right, a double-edged sword. And that ethical sourcing part, CAFE practices, how important is that?
It's become a really key part of their brand identity and their premium positioning. CAFE practices, coffee and farmer equity practices, was developed years ago with Conservation International. It set standards for their suppliers covering economic transparency, social responsibility, environmental leadership.
So it's about ensuring beans are sourced responsibly.
Yes, and sustainably. It helps guarantee them a long-term supply of the high-quality Arabica beans they need, which is vital for their product consistency. But just as importantly, it resonates strongly with consumers, especially younger generations who care about ESG factors, environmental, social governance.
Yeah.
It reinforces that premium image and helps justify the premium price. It's both good business practice and good branding.
Okay, we've got a solid picture of Starbucks internally now. Let's zoom back out and look at the wider world they operate in. Where does Starbucks sit in the massive global coffee market and the even bigger fast food or QSR market? And what does that competitive battlefield look like today? You said it was intense.
Yeah, Starbucks operates right at the busy intersection of 2 enormous global markets, So you've got the specialty coffee market itself, Thing cafes, premium beans estimated around $74 billion globally in 2025 and projected to grow steadily to nearly $97 billion by 2029. That's healthy growth, around 7% a year.
74 billion is big, but you said the QSR market is even bigger.
Oh, way bigger. The overall quick service restaurant market, fast food, fast casual, everything is forecast to hit something like $1.25 trillion by 2033. Just a colossal industry.
So Starbucks is playing in massive sandboxes, lots of opportunity, but presumably tons of competition.
Exactly. Huge potential, but incredibly crowded and dynamic.
What are the big trends shaping these markets right now? What does Starbucks absolutely need to get right to stay ahead?
There are a few really critical trends that are changing the game. First, premiumization. This has been a tailwind for Starbucks historically. Consumers globally are trading up, wanting higher quality specialty coffee, often with a story behind it like ethical sourcing. They're willing to pay more for better coffee.
Okay, that plays to their strengths. What else?
Second, convenience and technology integration. This is huge in QSR now. Digital ordering, mobile apps, delivery options. These aren't differentiators anymore. They are absolute table stakes. You have to have them, and they have to work seamlessly. And now you're seeing AI and automation being used more for optimizing operations, personalizing offers.
Technology is key.
Yeah.
What about health and sustainability? Those seem like massive global trends.
Absolutely critical. Third is health and wellness. Consumer preferences are definitely shifting. People want healthier options, maybe lower caffeine, protein boosts, more transparency about ingredients. Functional beverages are a growing category. And fourth, as we touched on with sourcing, sustainability, and ethical practices. This is a huge deal, especially for millennials and Gen Z consumers. Brands that genuinely commit to this stuff can build really strong loyalty. Starbucks' CAFE practices gives them a good story here if they leverage it well.
So it's a complex landscape. Premium is good, tech is essential, health matters, and ethics count. Who are the main competitors giving Starbucks headaches in this environment? You mentioned that squeeze.
Yeah, that squeeze dynamic is really the heart of their competitive challenge right now.
Yeah.
They're getting hit from multiple angles. First, you have the direct QSR competitors, the big guys.
Like Dunkin'.
Exactly. Dunkin' positions itself as more accessible, more value-driven, focuses on speed, convenience. They've got over 9,500 stores in the U.S. They compete directly on coffee, breakfast, snacks, usually at a lower price point than Starbucks. They appeal to that everyday, no-fuss customer.
McDonald's. McCafe is everywhere.
McDonald's is a behemoth. Their McCafe offering is a massive threat just because of McDonald's incredible scale over 41,000 locations globally, plus their financial muscle and operational prowess. McCafe really made espresso drinks mainstream and accessible at a lower price, and now they're experimenting with Cosmicons, this new small-format, beverage-focused concept that looks like a direct shot across Starbucks the bow, targeting that customizable specialty drink market.
Wow, Cosmix is. Yeah, that's interesting. Any others in that big QSR bucket?
You've also got Tim Hortons, which is dominant in Canada and trying to expand more in the U.S. Similar value and convenience play to Dunkin'. So that's the pressure from below on price and speed.
Okay, so that's the value convenience threat. What about the other side of the squeeze, the experience players?
This is where the emerging and niche threats come in. You've got these fast-growing chains like Dutch Bros. They're expanding like crazy, really connecting with younger people through highly customizable drinks, especially cold ones, super fast and friendly service, and this really energetic, almost cult-like brand vibe. They are definitely stealing visits from Starbucks.
A different kind of energy.
Totally. And then you have the vast, fragmented world of independent coffee shops. Thousands of them. They compete on things Starbucks struggles with now: true authenticity, artisanal quality, unique local atmosphere, community connection. Data shows these smaller players are gaining share, especially for those longer visits where people want to sit, relax, and have a more unique experience. They're hitting Starbucks right in its original third-place territory.
So it really is a squeeze. Attacked on price and speed by the giants, and attacked on experience and authenticity by the specialists and independents.
That's the dynamic perfectly. And it explains why the Back to Starbucks plan has to do two things at once. Improve operational speed to fight off the Dunkins and McDonald's of the world, and reinvest in the store environment and product quality to fight off the Dutch Bros and the local artisanal cafes. They have to defend both flanks simultaneously. If they fail on either, they risk losing market share and that precious pricing power.
It's a tough balancing act. But despite all this pressure, they still have that economic moat you mentioned. What are the core pillars of that enduring strength? Why are they still the leader?
Even under siege, Their moat is formidable. Let's recap those core strengths. First, brand strength. It's still one of the most valuable consumer brands globally. It's synonymous with premium coffee for millions, offering a promise of consistency wherever you go. That historically allowed premium pricing and built incredible loyalty. Second, scale and real estate. That network of 41,000 plus stores creates huge economies of scale, buying power, distribution efficiencies. And their sophisticated real estate strategy locks up prime high-traffic locations. That's a massive barrier that's hard and expensive for others to overcome. Location still matters.
And operationally.
Third, operational efficiency and supply chain. Despite recent stumbles, their vertically integrated supply chain gives them cost advantages and quality control that smaller players can't match. They manage the bean from farm to cup for consistency.
And fourth, the digital side again.
Yes. Fourth, technology and digital platform. That Starbucks Rewards program and the mobile app create a powerful ecosystem. It boosts convenience, fosters loyalty, and generates tons of data for personalization. This creates high switching costs. It's just easier for millions of members to stick with Starbucks. That digital moat is a really significant competitive advantage, even now.
Okay, we've got the business model, the operations, the intense competition. Now let's dive into the financials. What are the hard numbers telling us about Starbucks' health recently? How has this perfect storm impacted their revenue and profits?
Well, if you look at their revenue trajectory over the last decade or so, you see a story in two acts. Act 1, from roughly fiscal 2015 to fiscal 2023, was pretty much a story of robust, almost relentless growth. Revenues climbed from about $19 billion to $36 billion. Driven by consistently positive, comparable store sales and aggressive global store expansion. The only real blip in that period was fiscal 2020 due to the initial shock of the COVID pandemic. Otherwise, they were a growth machine.
Okay, that's Act 1. What happened in Act 2? It sounds like the music changed.
It changed dramatically. Act 2 began around fiscal 2024. That year, revenue growth basically flatlined up only about 0.5% to $36.18 billion. And that stagnation has continued into fiscal 2025. While the headline number for Q3 FY25 showed revenue up 4% to $9.5 billion.
That sounds okay, 4% growth.
It sounds okay until you realize that increase was entirely due to opening new stores. The underlying comparable store sales, as we discussed, were negative. So the growth from existing stores, the core engine, had stalled out. That's a major structural break from their historical growth pattern.
Okay, so top line growth stalled. What about the bottom line? Profitability, surely that took a hit too.
Oh, big time. Alongside the revenue slowdown, profitability has been squeezed hard. The most alarming trend here is the sharp drop in their operating margins. In Q3 of fiscal 25, their main operating margin collapsed by 680 basis points compared to the previous year. It landed at just 9.9%.
680 basis points. That's a 6.8 percentage point drop, right? That's huge. What caused such a steep decline?
It was really that perfect storm hitting all at once.
Yeah.
You had the financial deleverage from negative comps fixed costs, like rent spread over fewer sales dollars. You had those big necessary investments in store partner wages and benefits. And you had increased promotional spending to try to drive traffic. It all combined to crush margins. Even for the full fiscal year 2024, the operating margin shrank by 130 basis points, or 1.3 percentage points, down to 15%.
How does that 15%, or even worse, that recent 9.9%, compare to where they used to be? What was considered normal for Starbucks?
Historically, Starbucks was famous for its best-in-class margins, often in the high teens, like they hit almost 20%, 19.7% back in 2016, and were around 17% in 2019, pre-pandemic. So seeing margins down in the low double digits, even single digits recently, is a massive change. It clearly shows the cost of this turnaround effort and the tough environment they're in.
And the analysis suggests this isn't just a temporary blip. We shouldn't expect them to snap right back to 17-18% margins soon.
That seems to be the consensus, and it's logical. Management is explicitly investing heavily in labor and the store experience. Those are ongoing costs, not one-offs. So financial models probably shouldn't assume a quick V-shaped recovery in margins. The new normal for Starbucks profitability is likely structurally lower, at least for the medium term, as they prioritize reinvestment over maximizing short-term profit. Their net profit margin tells a similar story, falling from nearly 11.5% in FY23 to just over 7% more recently.
Okay, lower profitability for a while.
Yeah.
What about how efficiently they're using their capital? Metrics like return on invested capital, and can you clear up that confusing negative return on equity number?
Right. Despite the margin pressure, the underlying business is still pretty good at generating returns on the actual capital invested in building and running the stores, the roasteries, etc. Their return on invested capital, or ROIC, has always been a strength. While it's come down from its peak, it's still respectable, running somewhere between, say, 12.8% and 15.6% recently.
And that's good because
Because it's well above their estimated cost of capital. It means the core operations are still creating value. They're earning more on their investments than those investments cost them.
okay, ROIC decent, but then you see return on equity, ROE, and it's like negative 40%. That looks terrifying on a stock screener. What's going on there?
Yeah, that negative ROE number is highly misleading and often trips people up. It was negative 41% recently. But it is not because the company's losing money. It's purely an accounting artifact
An artifact of what?
of their aggressive share buyback programs over many, many years. They've bought back so much of their own stock that the book value of their shareholders' equity on the balance sheet has actually turned negative. It's a deficit position.
So the E in ROE, the equity number, is negative.
Exactly. And when you divide net income, which is still positive, by a negative equity number, you get a meaningless negative ROE ratio. Tells you nothing about their operational performance. The key takeaway for listeners is, if you see that negative ROE for Starbucks, basically ignore it. Focus on ROIC instead for a better picture of capital efficiency.
That's a really important clarification. Okay, what about cash flow? Are they still the cash-generating machine they're known for, or has that also taken a hit?
They definitely still generate a lot of cash. That's a fundamental strength of their scale and business model.
Yeah.
Over the last 12 months, they generated about $4.9 billion in cash from operations. But yes, the pressure on profits is flowing through to cash flow.
How so?
In the first 9 months of fiscal 25, their operating cash flow is down 26% compared to the year before, landing at around $3.4 billion. That drop directly reflects the lower net income and also some changes in working capital.
And free cash flow, the cash left over after reinvesting in the business.
Free cash flow, or FCF, has also tightened up. It was about $2.25 billion over the trailing 12 months. For the first 9 months of FY25, it was roughly $1.5 billion after subtracting capital expenditures, the money spent on new stores, remodels, technology, etc.
So less free cash. What does that mean practically?
It means they have less immediate flexibility for things like big dividend hikes or massive share buybacks. It also really underscores why this turnaround needs to succeed. They need that FCF to be healthy again, to fund their strategic plans and reward shareholders comfortably over the long haul. Cash is king, and it's gotten tighter.
Finally, on the financials, let's look at the balance sheet. How much debt are they carrying? And can you just reiterate why that shareholders' equity is negative so it's crystal clear?
Sure. Their balance sheet looks pretty typical for a large, mature company that's consistently returned cash to shareholders. As of Q3 25, they had about $17.3 billion in total debt. Their leverage is moderate. The net debt to EBITDA ratio is around 3.17x.
Meaning their debt is about 3 times their annual earnings before interest, taxes, depreciation, and amortization.
Roughly, yes.
Yeah.
That's considered manageable. They have strong credit ratings, good access to capital markets. They actually issued $1.75 billion in bonds relatively recently in May 2025, showing they can still borrow effectively when needed.
And that negative equity again. Just hammer that home.
Right, that negative shareholders' equity balance, which was almost negative $8 billion, negative 7.69B, at the end of Q3 25, is purely the cumulative result of decades of share buybacks. They've returned more cash to shareholders through buybacks than they've accumulated in retained earnings over the company's history. For a consistently profitable cash-generating company like Starbucks, this is not a sign of financial distress. It's an accounting outcome of their capital return policy. Fundamentally sound, just an unusual-looking balance sheet number because of those buybacks.
Crystal clear. Thanks. Okay, so financially, they're under pressure. Profits and cash flow are down, but the underlying business still generates returns, and the balance sheet is manageable. This leads us right back to the big plan, the back to Starbucks strategy. Let's unpack the strategic initiatives and growth vectors. What's the actual blueprint for this reinvention?
This back to Starbucks strategy, really kicked off by CEO Brian Niccol in September 2024, is the absolute central focus right now. It's not just tweaking things, it's a comprehensive response to those issues we've discussed, the operational problems, the falling traffic, the sense that the brand maybe lost some of its shine since around 2022.
And management sounds confident. You mentioned they think they're ahead of schedule.
They do sound confident in their public statements. They're projecting optimism. But as the analysis points out, the financial results haven't quite caught up to that optimism yet. The proof isn't fully there in the numbers. It's a massive undertaking turning a ship this size.
So what are the core pillars of this strategy? Or what are they actually doing?
Okay, pillar number one is all about operational excellence. They've branded this internally as winning the peak. It's a fundamental rethink of how the stores operate day to day.
Focused on speed and efficiency, especially during those busy mornings.
Exactly. The goal is to improve speed of service, get orders right more often, just make the whole process smoother and faster, especially when the lines are long. They're using data to staff stores better, rolling out improved equipment like faster espresso machines, and simplifying tasks for the baristas, the partners, to cut down on bottlenecks.
What's the target? Like, how fast do they want to be?
The stated goal is to consistently deliver a high-quality drink in 4 minutes or less. If they could achieve that reliably, it's a huge win for customer experience, and it means they can serve more people, boosting sales, what they call throughput.
Okay. Speed and efficiency. Pillar 2.
Pillar 2 is reestablishing the third place. This is really interesting because it's a direct admission that maybe in the push for speed and mobile orders, they kind of neglected that original core concept of the store being a welcoming space between home and work.
So they want people to hang out again.
That seems to be the goal. The strategy involves reinvesting in the physical environment, making stores more comfortable, more inviting. We're talking tangible things, bringing back ceramic mugs for here orders instead of just paper cups, adding more comfortable seating, making sure there are enough power outlets for laptops, maybe updating the decor to feel warmer.
That's a defensive move against those independent coffee shops taking the linger longer customers.
Absolutely, it's crucial. They need to win back customers who want more than just a quick transaction, reminding them of that cozy, welcoming vibe Starbucks used to be famous for.
Makes sense. Speed for some, comfort for others. What's pillar 3?
Pillar 3 is product and brand innovation. They can't just fix operations. They need to keep the menu exciting too. There's a renewed push to reinforce their coffee leadership. You see this in marketing campaigns for more coffee-forward drinks like the Cortado.
Getting back to coffee basics, in a way.
In a way, yes, but also innovating. They're making strategic investments, like buying coffee farms in Guatemala and Costa Rica, partly as R&D centers to develop new, unique coffee varietals for the future. And looking ahead to 2026, they're talking about a pipeline of new stuff, new food items, adding protein options to drinks to hit that wellness trend, even customizable energy drinks to compete in that growing category. It's about staying relevant and giving people new reasons to choose Starbucks.
You mentioned Brian Nichols' background at Chipotle being key. How does his specific experience translate here? Why is he seen as the right person for this job?
His appointment was a big deal, widely seen as a positive move by the market. His turnaround at Chipotle is legendary in the restaurant world. He came in after their food safety crisis, stabilized the brand, and drove incredible growth.
How did he do it?
By focusing relentlessly on the basics. Operational excellence in the restaurants, fixing the supply chain, reinvigorating the brand message, and crucially making huge strides in digital innovation to make ordering easier and more convenient. That playbook, fixing operations, rebuilding brand trust, leveraging digital, is almost perfectly aligned with what Starbucks needs right now. His track record significantly boosts confidence that this turnaround can succeed. He's done it before in a complex QSR environment.
Okay, so the turnaround plan is focused on the core business. What about longer-term growth? Where does Starbucks see big expansion opportunities down the line beyond fixing the current issues?
Even with the near-term focus on the turnaround, international expansion remains the biggest long-term growth engine on their radar. And within that, China is still the most critical piece, despite the recent challenges.
Is China recovering? We heard comps were up slightly there recently.
Yes, there are definitely signs of recovery. Q3 FY25 saw positive comps, up 2%, driven by a healthy 6% increase in transactions. That's encouraging. Customers are coming back.
But the landscape there has changed, right? With competitors like Luckin Coffee.
Permanently changed. Luckin Coffee now has more stores in China than Starbucks and competes incredibly aggressively on price and digital convenience, often targeting different locations and customer segments. This new reality means Starbucks can't just focus on opening hundreds of new stores there anymore. The strategy is shifting towards profitable growth, maybe being more selective with locations, and management has even hinted at exploring strategic partnerships to operate more effectively in that unique market.
So China is key, but complex. What about other international markets?
They have a pretty diversified portfolio, and other markets offer strong potential too. International revenue topped $2 billion in Q3 25 for the first time, which is a milestone. They highlighted strong performance in places like Canada, the UK, Mexico, Turkey. So it's not just about China internationally. There are multiple growth avenues.
And how are they evolving the actual stores, the physical footprint? Are we going to see radically different types of Starbucks popping up?
They're definitely adapting. Drive-through expansion continues to be a major priority. Why? Because customers want the convenience, and drive-thrus consistently perform really well financially, higher sales per store, strong profitability. There's just good business.
Makes sense. What about other new formats?
They have this long-term, maybe ambitious goal to potentially double the number of stores in the U.S. eventually. A big part of that would involve rolling out new formats, those smaller, cheaper-to-build concepts like pickup-only spots or delivery-focused kitchens. These are great for filling in gaps in dense urban markets where a full cafe might not make sense or fit.
And what about the really high-end stores, the reserve roasteries? Do they still fit in?
Yes, the premiumization effort through Starbucks Reserve,
Mm-hmm.
the big roasteries in major cities, the smaller reserve bars, they serve a strategic purpose. They act as a halo for the whole brand, reinforcing coffee quality and craftsmanship. They're also innovation labs where they test new brewing methods and rare coffees. It's about showcasing their coffee authority and keeping that premium edge sharp.
And finally, on the strategy front, the digital side. How are they planning to make that digital moat even wider and deeper?
Digital remains absolutely central. As we mentioned, that new app and loyalty refresh planned for 2026 is a big deal. It's not just a facelift.
What's the goal?
The goal is to deepen engagement with those 34 million plus active rewards members in the U.S. Leverage all that data they have for even better personalization, suggesting drinks you might like, offering tailored deals. The aim is to increase how often people visit, encourage them to spend more when they do, drive higher ticket sizes, and ultimately make that digital ecosystem so seamless and rewarding that it further solidifies their competitive advantage. It's about making it almost effortless and highly beneficial to be a loyal Starbucks customer.
Okay, strategy sounds comprehensive. Now let's rewind a bit and be really clear about the period before this turnaround started. What exactly happened between, say, 2022 and 2024 that created this perfect storm and made the overhaul so necessary?
Yeah, that period really was a confluence of major headwinds hitting them all at once. It significantly disrupted their momentum. First off, you had massive inflationary pressures. The cost of everything went up.
Coffee beans, milk, sugar.
All of the above. Green coffee prices hit multi-decade highs at one point. Dairy, sugar, paper cups, all their key inputs got much more expensive. Even with hedging programs, these sustained cost increases squeezed their gross margins significantly.
And labor costs too, right? That was a huge topic.
Huge. The tight labor market across the U.S., combined with Starbucks making a strategic choice to invest more in its partners, higher wages, better benefits, more training hours, led to significant labor cost inflation. This was probably the single biggest driver of that operating margin compression we talked about. Necessary investments for the long term, maybe, but a major hit to short-term profits. Then there were internal stumbles too. Supply chain disruptions lingered longer for them than for some others, it seems. Management even admitted to unacceptably high out-of-stocks on certain popular items. That's lost sales right there. And it frustrates customers who can't get their usual drink.
In China, that was a massive drag during that period, wasn't it?
Absolutely brutal. The China market challenges were severe. First, the lingering impact of China's strict zero-COVID policies, which lasted through 2022 and into early 2023. That meant widespread store closures, reduced operating hours, people just not moving around. It decimated their results there for a while.
And when things reopened?
When things reopened, they faced intensified competitive pressure, especially from Luckin Coffee, which had used the disruption to gain ground. Luckin competes aggressively on price, digital convenience, and local tastes. You saw the impact clearly in Starbucks' numbers. China comps fell 8% for the full fiscal year 2024, a major setback. Adding to the complexity was the labor relations and unionization push in the U.S. The Starbucks Workers United campaign gained a lot of momentum, successfully organizing hundreds of stores. This created operational headaches, negative headlines, legal battles, and frankly, it was a major distraction for management.
And customers themselves changed, didn't they? Post-pandemic habits are different.
Definitely. There were lasting changes in consumer behavior. The rise of hybrid work fundamentally altered those traditional morning commute patterns that used to drive so much peak business. Fewer people stopping for coffee on the way to the office every single day.
Plus, inflation made people more price sensitive.
Exactly. High inflation led to increased value consciousness. Consumers started watching their spending more closely, maybe trading down to cheaper coffee options, maybe making more coffee at home. This likely contributed directly to those negative transaction counts, especially in the U.S. People were asking, is this daily Starbucks worth it? And finally, compounding all this was a period of leadership transitions. Howard Schultz came back as interim CEO, then handed off to Laxman Narasimhan, whose tenure turned out to be quite short, before Brian Niccol arrived in September 2024. While leadership changes can create uncertainty, the market seemed to welcome Niccol, given his track record, signaling maybe some relief that a clear path forward was emerging.
Wow. When you lay it all out, like the inflation, supply chain, China, labor, changes in consumers, leadership churn, it really does sound like a perfect storm. No wonder a major strategic shift was needed. So let's talk about the leadership now steering the ship. What's the assessment of management quality and corporate governance during this critical turnaround phase?
Leadership quality is absolutely paramount in a situation like this, and the analysis suggests Starbucks is now in capable hands. The CEO, Brian Niccol, as we've discussed, brings that highly relevant and successful turnaround experience from Chipotle. His reputation for focusing on operational excellence, smart digital innovation, and effective brand building makes him seem like a very strong fit for Starbucks' current needs. The market certainly viewed his appointment positively.
Is the team around him strong as well? It takes more than just a CEO.
It does. And the report suggests he's supported by a solid team, a mix of seasoned Starbucks insiders who know the culture and the business deeply, alongside experienced executives hired from outside who bring fresh perspectives and potentially different skill sets. People like Brady Brewer leading international, Kathy Smith as CFO, Sanjay Shah heading the supply chain. Looks like a good blend of internal knowledge and external expertise.
Okay, so capable leadership. What about the strategic vision itself, the Back to Starbucks plan? Is it the right plan? And more importantly, can they actually execute it across such a massive global organization?
The strategy itself, focusing back on operational basics, the customer experience, coffee quality, seems coherent and logical. It addresses the key weaknesses that emerged. It's a return to core principles in many ways.
But the execution?
That remains the primary question mark. The plan is ambitious. Implementing it consistently across more than 41,000 stores worldwide, changing processes, retraining staff, renovating stores, it's a monumental task. Management says they're making good progress, even ahead of schedule, but as we keep saying, the financial results haven't fully validated that yet. The proof will be in sustained improvements in those key metrics over the next several quarters. It's still very much a work in progress.
And who's holding management accountable? What about the board of directors? Is the oversight strong and independent?
The analysis paints a picture of a high-quality, largely independent board. It currently has 9 directors, the majority of whom meet independent standards. They also have a policy of either separating the chairman and CEO roles or appointing a strong lead independent director if one person holds both titles.
And Niccol is chairman and CEO now, right?
Yes, and significantly, Melody Hobson, the former chair and a highly respected figure, stayed on as the lead independent director. That ensures a powerful, independent voice, providing oversight and constructive challenge to management. The board also boasts impressive diversity and depth of experience. You've got current or former top executives from places like Microsoft CEO Satya Nadella is on the board, and Apple. That brings incredible expertise in technology, global operations, scaling businesses, brand building, skills that are highly relevant to Starbucks today.
And ESG oversight, is that formalized?
Yes, they have a dedicated committee focused on environmental, partner employee, and community impact. This demonstrates a commitment at the board level to formally overseeing these increasingly important ESG factors.
Final piece on governance. Is executive pay tied to making this turnaround actually happen? Are they incentivized to succeed?
Yes. The compensation structure appears well aligned with shareholder interests. A significant chunk of executive pay is performance-based and at risk, meaning they only get it if the company hits certain targets.
What kind of target?
Things like growth in adjusted earnings per share, adjusted net revenue, and critically, how Starbucks' total shareholder return compares to a group of peer companies. So they're directly incentivized to deliver profitable growth and beat the competition.
And Niccol's package specifically?
His package is heavily weighted towards equity and performance. He received a large replacement grant when he joined, worth around $75 million, but 60% of that is in performance-based stock units. His payout is directly tied to the success of the turnaround over the next 4 years. Plus, shareholders get a non-binding vote on executive pay, say on pay, which adds another layer of accountability.
Okay, so it sounds like the structure is there. Experienced leadership, a clear if challenging plan, independent oversight, and aligned incentives. Now, the big question for investors, valuation. Does the current stock price make sense? Does it reflect the potential, or is it perhaps too optimistic given the hurdles?
Valuation is definitely a tricky piece of the puzzle right now for Starbucks. The analysis suggests the current stock price reflects a premium valuation that isn't fully justified by their recent performance,
But rather by,
by the expectation of a successful turnaround. The market seems to be giving them credit for fixing things before they're fully fixed.
let's look at the multiples. Price to earnings, the PE ratio, where does that stand?
As of August 2025, the trailing 12-month PE ratio was around 37.3x. That means the stock price is about 37 times its earnings per share over the past year. Interestingly, that's pretty much in line with its 10-year historical average PE of around 38x.
So despite the recent struggles, the market still values it like the premium growth company it used to be.
Largely, yes, although it is significantly higher than the PE got during previous rough patches, suggesting maybe more optimism this time. The forward PE, looking at expected earnings for next year, is a bit lower, around 34.7x, which indicates the market is anticipating earnings growth to support the current price. Looking at another metric, enterprise value to EBITDA, it was around 21.9x. That's definitely a premium multiple for a restaurant company, again suggesting investors are looking past the current depressed earnings and valuing it based on potential recovery. And the price-to-sales ratio is about 2.7x. Given the recent flat sales, that multiple looks a bit stretched or full. It suggests they really need to get sales growing again to justify it.
How does this valuation compare to their big peers like McDonald's or the owner of KFC and Taco Bell Yum Brands? Is Starbucks still getting a premium compared to them?
Yes, generally it still commands a premium valuation versus most large QSR peers. For instance, its PE ratio of 37x is significantly higher than McDonald's, 26.5x. Their EBITDA multiples are actually closer, 19.5x for SBUX versus 18.4x for MC8.
Why the big difference in PE but not EV/EBITDA?
It partly reflects their different business models. McDonald's is heavily franchised, which leads to higher margins but lower revenue, recognized by the parent company, distorting simple PE comparisons sometimes. Starbucks also trades at a PE premium compared to restaurant brands, owner of Tim Hortons, Burger King, and Yum Brands.
Why does the market consistently give Starbucks this premium, even now?
Historically, it's been justified by Starbucks' stronger global brand, perceived higher product quality, and its superior growth record, especially internationally. The brand halo is powerful. However, that premium becomes a major risk if Starbucks fails to restore that superior growth and margin profile relative to peers. The premium is based on potential, not current reality.
That makes sense. Could looking at Starbucks as a sum of its parts, North America, international, channel development, give a different valuation perspective? Maybe reveal some hidden value.
That's a really insightful approach to sum of the parts or SOTP analysis. It argues that valuing each segment separately might give a truer picture.
How would that work?
Well, you might assign a lower valuation multiple, maybe based on EBITDA, to the mature, slower-growing North America segment, similar to other stable U.S. restaurant chains. But then you'd assign a significantly higher multiple to the international segment, reflecting its much higher long-term growth potential.
And the channel development business, the CPG part.
That part, being capital light and high margin, operates more like a consumer packaged goods company. So you might value it using an even higher multiple, similar to what CPG companies like Nestle itself might get.
So the SOTP could suggest.
It could potentially highlight that the market, by valuing Starbucks on a consolidated basis, might be undervaluing the combined potential of the high-growth international business and the very profitable, stable channel development arm. It suggests there might be hidden value masked by the recent struggles in the core North American retail business.
Interesting perspective. What about a discounted cash flow or DCF model? What does that tell us about the intrinsic value, especially given this show-me situation?
A DCF analysis, where you project future free cash flows and discount them back to the present, really hammers home how sensitive the valuation is to the success of this turnaround. The output of the model depends heavily on a few key assumptions.
Like what? What are the biggest drivers?
Number one is revenue growth. Can they get back to positive comparable store sales, especially in the U.S.? And can they maintain solid international unit growth? Analyst consensus is currently forecasting about 7% annual revenue growth over the medium term, which is pretty optimistic given where they are now.
And the other big one is margins, right?
Absolutely. Margin expansion. How much can they recover those operating margins from the current depressed levels? Management talks about eventually getting back towards that historical 17% level, but the pace and extent of that recovery are huge unknowns that dramatically swing the DCF valuation.
So what's the conclusion from a typical DCF? Does it
Yeah.
support the current price?
Using standard assumptions like a long-term terminal growth rate of maybe 2.53% and a reasonable discount rate, WACC of 7.5, 8.5%, a DCF analysis likely suggests the current stock price is pricing in a reasonably successful turnaround. Not necessarily a flawless home run, but definitely a solid execution.
Which means?
Which means, to get significant upside from here, Starbucks needs to beat those already optimistic consensus expectations. They need to execute better or faster than the market currently believes they will. It reinforces that show me narrative. Failure to deliver could lead to a sharp downward re-rating of the stock as those optimistic assumptions unwind. The risk is definitely skewed towards execution failure right now.
Okay, that valuation picture is clear. Price for a solid recovery, sensitive to disappointment. So for listeners weighing the risks, what are the absolute key dangers that could derail this comeback story? What could, as you put it earlier, unbrew the comeback?
Understanding the risks is crucial. The analysis highlights several major ones. First, macroeconomic sensitivity. Starbucks sells a premium discretionary product. If there's a significant economic downturn, people will cut back. Less traffic, trading down to cheaper options, that would hit Starbucks hard. Second, those competitive threats aren't going away. The QSR giants, the fast-growing chains like Dutch Bros, the independents, the pressure is intense and relentless. There's a real risk of permanent market share loss if Starbucks can't effectively differentiate and compete on both convenience and experience.
And the execution risk you keep mentioning.
Third, execution risk is probably the biggest internal risk. The Back to Starbucks plan touches everything: staffing, training, store layout, technology, supply chain. Trying to implement this consistently across 31,000 plus stores globally is incredibly complex. Any significant stumbles in execution service doesn't improve, the experience doesn't get better, innovation falls flat, could completely derail the recovery.
What about external factors like costs or geopolitics?
Fourth, commodity price volatility. They're always exposed to swings in the price of coffee beans, dairy, sugar. If those costs spike again and stay high, it squeezes margins or forces them to raise prices, potentially driving customers away. Fifth, China market risk. Their heavy reliance on China for future growth is a double-edged sword. It creates concentrated risk related to the Chinese economy, U.S.-China political tensions, intense local competition, and potential regulatory changes. Instability there is a major threat. Sixth, labor relations. The unionization drive in the U.S. is ongoing. This continues to pose risks of higher labor costs, less operational flexibility if contracts impose rigid rules, potential disruptions, and ongoing negative PR. And seventh, brand reputation. Their brand is arguably their most valuable asset. It's vulnerable to things like food safety scares, customer data breaches, controversies over ethical practices, or getting caught up in divisive social or political issues. Any major hit to the brand could severely damage customer loyalty and sales.
That's a sobering list of risks. It really underscores the challenges ahead. So, given all this complexity, the plan, the financials, the risks, what are the absolute key metrics the listeners should watch like a hawk to gauge whether this turnaround is actually working? What should be on our dashboard?
Yeah, if you want to track the progress, you need to zero in on a few vital signs. The single most important metric, bar none, is same-store sales growth globally, but especially pay attention to the U.S. and China numbers. You need to see a sustained return to positive territory here. That's job one. And digging one level deeper within comps, the most critical component right now is comparable transactions. Is foot traffic actually increasing again? Seeing that number definitively shift from negative back to positive and stay positive would be the clear signal that they're winning back customers in visit frequency. Remember, U.S. transactions were negative 4% in Q3 25, while China's were plus 6%. Watching the trend in these transaction numbers is paramount.
Okay, top line traffic is number one. What about profitability?
You absolutely have to watch the operating margin. Is it stabilizing? Is it starting to gradually tick back up towards that long-term target of around 17%? Yeah. The pace and consistency of margin recovery will show if the operational improvements and pricing power are actually translating to the bottom line.
Anything else on the dashboard?
I'd also keep an eye on Starbucks Rewards member growth and engagement. Is that huge, loyal base still growing and actively using the program? That's a crucial indicator of the health of their core customer relationships. In China, specifically track both the store unit growth and the comps together, as both are key to that market's contribution. And finally, watch free cash flow generation. Is it improving? That tells you if they're regaining the financial flexibility needed to invest, pay down debt, and return cash to shareholders. These are the core vital signs that will tell the real story.
Fantastic. What an incredibly detailed deep dive. We've really unpacked the Starbucks puzzle, the operational hurdles, the financial strains, the competitive squeeze, but also the formidable strengths and that ambitious back to Starbucks plan under new leadership. It is absolutely clear they are at a crucial juncture, a real strategic inflection point.
Yeah, and despite all the headwinds, you can't ignore those underlying strengths. The brand is still iconic, the scale is immense, the digital platform is powerful, and they do have a clear roadmap, even if the execution is challenging.
Which brings us back to that final recommendation from the analysis.
Yeah.
A hold, with that constructive long-term view, but very much emphasizing the show-me nature of the stock right now. The market needs to see proof.
Exactly. Tangible evidence in the numbers is what everyone's waiting for.
So as we wrap up, here's something to think about, maybe the next time you grab a coffee, whether it's from Starbucks or somewhere else. Beyond all the spreadsheets, the market share charts, the strategic acronyms, what is it fundamentally about the experience of Starbucks? That third place idea, the daily ritual, the feeling of connection to the brand. What makes it so sticky for millions of people around the world?
That's a great question, that intangible connection.
Right. And what does that enduring human element, that brand loyalty built over decades, ultimately mean for Starbucks' long-term resilience? Can that connection help them weather these storms, regardless of the temporary ups and downs on the financial statements? Something for you to ponder with your next cup.